Bond market still stabilizing for 2024, but recessionary risks persist for 2025. Hi, this is Hugh from Boom Bust Invest. Every quarter, I put out a few videos here just to give my view on where I think global stocks and bonds markets are heading for our pensions, ISAs, IRAs, 401ks, etc. Applies and the overall health of the bond and credit markets. So kicking off here, we've got the macro-micro M2 money supply chart here. So you can see the shaded areas here, which is the overall M2 money supply for the four major central banks: US, Europe, Japan, China. As you can see, it's been very high since COVID and was on an upward trajectory for quite a while. The year over year, that's like the overall kind of nominal supply, I guess, but the year over year, the from the four major central banks, the year over year here, the orange and green, we can see here that it come down a long way from the top of the inflationary spike to October, November 2022, which is funnily enough when the stock markets started to recover. There's obviously a correlation there. We can see it's come off slightly here, but possibly heading back up again. So we would kind of need to see the year over year head back up again to be bullish on stocks. So yeah, that's an interesting sort of juncture there. We need to see that continue up. You can see the green line, which is the fixed exchange rate, another measure of the year over year. Again, that's turning up. So overall, you know, the sort of trend from these low points here is up. So overall, we'd say that's sort of bullish for our stocks and probably bond markets as well. Moving to trading economics here, the net percentage of domestic banks tightening standards for commercial industrial loans. So this is to small firms, mostly the real economy, I guess. We can see over this longer term view, we have come down here. So it means that banks are making more loans to smaller companies than they were, just a few months ago. Again, another possible juncture here, just ticking up over the previous quarter. We probably want to see this come down to be bullish on our stocks here. See, over the longer term here, going back to the 2000s and the 90s, it's actually still at quite, if it stays at around 20, that's quite a high elevated level, which shows that banks are not making as many small loans to small firms here, which is probably a warning sign if that continues. So again, we just track these each quarter. So if you like and subscribe, you'll get notifications for these videos when I bring them out. As we can see here, the dot-com bust here, quite a lengthy period with high periods where banks are tightening. The great financial crisis here, quite a high peak, where banks were not making loans, and this is COVID. So we actually came up very high here in 2022, or the end of 2023. So we have to see if that continues, but that's overall coming down. So again, cause for optimism overall there. The Federal Reserve St. Louis Fed chart here so this is for large and middle market firms here. So this is more of our larger cap loans. The demand for loans here for commercial industrial loans for our large cap stocks here. So more of what we might be invested in our pensions, for example. And we can see we've actually came down to a very low level here, Q2 2023. Again, heading in the right direction, but below the zero line here, the black zero line, this is where the problems occur. You can see here, dot-com bust, long period below zero, the great financial crisis, long period below zero, and like now we've just dipped back below here, come very low here, similar to the peak of the great financial crisis, but apparently there's no recession here. So we must have had something similar, possibly just not classed as a recession. But anyway, again, heading in the right direction. Once again, just at a juncture point here, possibly, and for the previous quarter, if that continues to head down, that would be bearish. If it continues to head back up to the zero line here, that would be bullish. So not out of the woods yet, but we need to see that continuing back to zero to be confident. Chicago Fed here, National Financial Conditions Index, which is widely watched for the health of the credit markets and various other financial conditions that you'd want to see for healthy stock and bond markets here. Again, at the moment, all looking good, heading in the right direction. So below the zero line is good. We can see COVID here. Let's zoom this out. So you can see a great financial crisis, for example, as a comparison. And so here we can see great financial crisis where things can turn above zero, can turn quite nasty quite quickly here. So, it's heading in the right direction. But if we start to see something like this, you start to normally see it sort of trending up here, as you can just see here, for about a year or so before. So we're heading in the right direction at the moment. But if we start trending back up to zero, then that would be a warning sign. But there's nothing to see here. There's no sign of that happening as yet. So this widely looked at index is saying that we're quite healthy at the moment. Back to trading economics here. The Chicago National Fed, again, is another view of the same index over the longer term here. It's just heading back down to very low levels. So this was the Great Financial Crisis. As you can see, we are nowhere near any kind of crisis as we stand. Another one here from isabelnet.com. Financial conditions. This is Bank of America Global Research for the G3. So we've got the US, Eurozone, and UK. Below zero is bad, above zero is good. You see the Great Financial Crisis here. And we see at the moment we're heading in the opposite direction. So this was around about the sort of sovereign debt crisis here, -4. This was COVID, getting down to about -7. And at the moment we're above zero. So another measure, financial conditions, saying that we are in rude health currently. St. Louis Fed here. So this is the high yield index option adjusted spread. So it's a measure of the costs and risks in the high yield bond markets. As we can see here, that's COVID. This is where we are now. If we take it back to Great Financial Crisis for a comparison, you can see here we are nowhere near any kind of real problems in terms of the bond markets. Another one here. So that's for the US. This is for the euro. Same chart for the eurozone. We'll see when it loads that it's the same story for the eurozone. Moving on to the New York Fed here, just their take on things. The corporate bond market functioning appears healthy. The end of month market level CMDI is below its historical 15th percentile. Market functioning in both high yields, investment grade sectors remained within historical norms for the past month. That's May 2024. As you can see here, here's the Great Financial Crisis. Here's where we are now. Again, on trading economics, so bankruptcies. You can see it's actually heading in the wrong direction in terms of bankruptcies. Looks a lot. 20,000 companies over the past quarter. This is the 3-year chart, highest in 3 years. However, when you zoom out to the max chart, so going back to the 90s, you'll see it's actually still a relatively low level. If we see it heading up sort of, in a similar trajectory to 2008, then that might be more cause for concern. But currently heading in the wrong direction, but within sort of normal levels in terms of the historical figures here. And then on the UK side, take this maybe as a barometer for Europe. So UK and some other European nations did hit recession, a temporary recession. But so March 2024, come back down from sort of higher base here. So heading in the right direction here. If we zoom out, so actually this is telling the opposite story. So we've got higher levels since 2022. We've had high levels of bankruptcies, and that's sustained. So this is probably more of your smaller firms. So smaller firms have struggled with high inflation, so this is understandable, but it has remained high. And so if you compared to, go back to 2000, before 2000, they must have used a different measure here because it's come right down. So even going back to 2000, it's the best part of 30 years, we're still at high levels here. So if that continues, that would be sort of possibly bearish, pointing towards there are sort of recessionary indicators that we're seeing that could still come to bear possibly in 2025. So we'll keep our eye on this. And then the yield curve inversion, which is still ongoing, one of the longest yield curve inversions that we've seen, which again is another warning sign here. If we focus on, if we can get it to load, if we focus on the big one, which is the 10-year, 2-year, minus 2-year, been inverted for quite a long time. Just get rid of these annoying pop-ups here. So as we can see, coming out of the dot-com bust here, we see the yield curve inversion, and it's usually when something's broken. And if the recessionary warnings come to bear, we could see the same pattern playing out where they have to lower interest rates because something breaks, and then we're in a recession, and then our stock portfolios come down. These kind of what we could be heading to with lower interest rates would be, for me, sort of rotation into bonds would be a better play possibly here than sticking to equities. But again, this is slightly ominous. See, this is 90s coming out from yield curve inversion. We see recession. Dot-com bust coming out of yield curve inversion, recession. Great financial crisis, same story. And quite possibly we could see the same story happening here with the 2025 recession. Again, just on isabel.net here, or isabelnet.com, probability of a US recession from the yield curve, which is pretty accurate as we've seen. And currently stands at 54%. So this is from the Federal Reserve Bank of Cleveland. As you see here, it's still pretty high. This is the great financial crisis. This was a dot-com bust here, and we're still above it. We're still above. We hit a peak here greater than the 1970s. We're almost at the peaks of the 1980s. We had all of those long years of problems with recession and problems in the 80s, and we're at similar levels. So again, coming down, but not out of the woods, 50-50. So there's a good chance we will see this recession going forward in the coming year. So yeah, I mean the big one, the 10-year Treasury bonds, which is what everything else is measured against. Just to finish off on that, you can see it heading in the right direction, coming down, which means that our bond prices of bond funds should be heading up if this continues. But we'd need to see this continue down. We'd need to see this. This is just a 1-year chart. So if we go to the 5-year or the 10-year, we're still pretty high. However, this is looking more like a lower high. So higher high, higher high, higher high, lower high. If this continues down, which is your change of trend. So our bonds should do better if this continues, but we'd need to clear this 4.2 level, this previous higher high here, to confirm that change of trend. We see it, we could range, but if we see it continue up, then it's a continuation. If we then break this higher high, but it doesn't look like it. It looks like it has changed, and with the US Fed saying that it should have at least one rate reduction this year, then we should see this edge down. So the bond markets and the central banks facilitation of financial markets is looking bullish for stocks and bonds currently, although it's stubbornly high. These rates are stubbornly high. We'd need to see them come down for this trend to be confirmed. And if we see that, there's still the risks of recession 2025. But if these do come down, and then we may still get this soft landing and avoid a recession, and our stocks and bonds can continue on their merry way up. So that's the Goldilocks scenario that the Federal Reserve is aiming for, and at the moment that they appear to be on course for that. So I hope you enjoyed the video. Please like and subscribe if you've got something from that. So you'll see these videos when I release them on the channel, and they'll also be in the playlists on the YouTube channel as well.